Unrivaled Nation, I'm excited to talk to you about today, October's 2021's their potential multi-bagger. We are looking at Fairfax Financial, why I own the stock, why it's part of my personal journey, and why I think it has 200 to 300% upside and maybe more over time. Let's dive in to understand the setup. Here's a disclaimer. So at its heart, Fairfax is a conservatively run insurance company generating over $20 billion in annual premiums. And they have a very diversified book of business across different types of insurance specialties as well as geography where they're writing that insurance. What makes insurance companies special, to take a step back and understand, is that you're usually paid upfront via a premium. It might be for a year, it might be covering multiple years, and you'll sit on those funds, those premiums, until there's a claim. If there's a claim, that pool of capital is called a float. You can see how that float has grown over time for Fairfax. And critically, they've been paid to hold that float. So their float has grown from 13 million to nearly 25 billion. So it's grown very significantly over time. And the benefit of the float shows that it's actually been a net benefit. It hasn't cost them to write that float, i.e. they're writing profitable insurance. So let's say you write a $100 premium where a customer pays you $100 to say, hey, I'd like to insure XYZ risk. They say, sure. And generally, of all the different premiums that have been written, they'll pay out like $25 in claims. That's the goal. And then keep the other $5 as a profit. So here it is. They're saying, look, we kept the equivalent of $1 as profit. Whereas a lot of insurance companies, they're generating losses. So not only do they get to keep profitable insurance contracts, but they can reinvest the float and keep the gains there as well. Now, insurance is a very special business because if you can generate great returns on your investment portfolio, plus you're writing profitable insurance, then you could have a real rocket of a business. And one could argue that's largely what has funded Berkshire Hathaway's incredible growth, is having two very profitable revenue drivers that they then layered into other profitable business drivers, such as operating businesses that are outside of insurance. And so management has a long history of performing intelligently and conservatively since 1985. And critically, I believe they've created a culture that thinks about risk prudently. You can look at how Redline's Fairfax share price, the other is their book value. The book value is these columns, and then the S&P index. And you could see how they've just crushed the index over time. That said, in the recent period, it's been very lackluster over the past decade, and we'll talk about why that is in a second. So this past decade, their returns were very weak, largely because Prem Watsa used large macro hedges betting on deflation. Now, it's worth noting his macro hedging performed very well during the great financial crisis when he said, hey, there's a subprime issue, let's make a bet. So you can't just fault him for, oh, you made one bad bet here. It needs to be considered across both periods where, yeah, so you made a good call here, but you overdid it on the macro hedges in terms of betting on deflation. And subsequently, he's pretty much said, yeah, I'm not going to be doing these shorts and this deflationary bets again. So why is this part of my journey if you've sort of had this lackluster period over the last few years? And so here it is. I purposely chose this picture. There was a fire in the Palisades in Southern California, and I went on a hike over there after the fire just to sort of check it out. And, I think the metaphor might be appropriate is that when you have a period where sort of things are bombed out or people aren't really, it's not very attractive, there's that opportunity for growth in the years ahead and significant growth that people might be overlooking because they've had a poor few years. And so the simplest reason why I like and own Fairfax Financial is because I trust management and like the upside potential. With reasonable assumptions, and you can see the various different assumptions here, I think there's the potential for them to make, somewhere between 70 and 260% return in the next 5 years. This is sort of an upside analysis based on a range of what I think are reasonable assumptions. Another key element is that there's a lot of value that they haven't yet recognized that's a meaningful part of their adjusted book value. So take a step back. With insurance companies, they're generally valued as a measure of price to book value. How fast do you think they'll grow their book value? If they're doing it profitably at a good rate, then it'll be valued around book value, somewhere a range of, let's say, 0.8 times to 1.2 times, maybe even more. In the past, Fairfax could trade 1.5, even higher. So currently it's around $410 as a share price. Their book value is around $540, so they trade at about 25% discount to their stated book value. But they also have some significant adjustments, about $67, $68 worth per share in adjustments, the largest of which is Digit, which we'll talk about in a second. So when you adjust their book value for these adjustments, it's really trading at closer to a 33% discount to book value. So that starts getting interesting, because then you go, wait a second, this in the future might trade at a premium to book value if they start putting up strong figures, or if these adjustments like Digit gets recognized in the coming quarters. Folks might say, oh wow, that's a 10% increase in book value in one quarter. That's pretty interesting. And so the question is, well, okay, so what do they look like in the years ahead? What's their compound rate? Their stated goal is to grow around 15%. That's their goal. I do a range of 5 to 15%, once again, trying to be reasonable and conservative, and a range of multiples from 0.9 to 1.2. It's possible you can get even higher if folks start saying, wow, this really has a potential start to compound, but let's say between 10 to 15% for long periods of time, then I think you'd get even more than 1.2. So in this case, you're seeing an annualized potential of 11 to 29% annualized over the next 5 years, 70 to 260% upside. I personally think this is a much more very conservative case. If you start, effectively, if you have a global catastrophe type of situation, that's how I look at this sort of case. Whereas I say, hey, if things really execute, you're more likely to execute along these lines. But this is an upside scenario. Once again, if there's a true downside risk, maybe it gets hit even worse. So let's talk about Digit, one of the key components of their adjusted book value. And Digit is an insurance tech business founded with the backing of Fairfax Financial just a few years ago. And since then, they've grown at hyperscale to nearly $1 billion in annual premiums. And they're growing hyperspeed, over 60% plus a year. And in India's insurance market, unlike the United States, this is viewed as significantly underdeveloped and a huge opportunity for, let's say, new players to come in and disrupt it with better service and just rapidly growing scale. And so I like the fact that you're combining Fairfax's conservative culture with the latest and greatest of technology to grow an insurtech platform. And so to hear, wow, from nothing to $1 billion in annual premiums, that sounds interesting. That sounds like you're doing a disruptive thing. Fairfax invested around $154 million and is currently on their balance sheet. This investment is currently on their balance sheet for around $532 million. And keep in mind, they still own nearly half of Digit. Digit is in the process of raising around $200 million in new equity from Sequoia Capital and other VC funds. Sequoia is a major VC fund. If you haven't heard of them, major prestige. It certainly gets sort of like this halo effect when you hear like, oh man, Sequoia is also interested. And they're investing at a $3.5 billion valuation. So that's significant. So if Digit continues to grow at hyperspeed, there's a chance this business alone could be worth multiples of Fairfax's current market cap of around $11 billion. Now, for perspective, their investment in Digit includes the Digit insurance app that's getting this $200 million investment. So that's effectively like a subsidiary of Digit. So their stated value in Digit is now closer to $2.3 billion based on this $3.5 billion valuation. That's according to one of their press releases. So you could see, wow, if you have a business growing at 60% plus, it wouldn't be hard to imagine a scenario in the coming decade where this is worth literally multiples of their market cap if you continue to have, let's say, 40, 50% growth. I also like, so thinking about the different factors on why I own this, things that could work out favorably for Fairfax. I also like that Fairfax could be a net beneficiary of higher interest rates. For example, about 40% of their investment portfolio is effectively collecting zero because it's in very short-term U.S. Treasury bonds. So if you have higher interest rates, that's more income going to them. And they're doing that out of a preponderance of caution and a culture of conservatism. So they also have a culture of conservative underwriting. So for example, in 2020, their insurance was still profitable. And I think that's a big deal, and I'll talk about a little bit later as well. They also have a series of very interesting value-oriented bets that may or may not pay off. A lot of folks recognize they've had this bet in BlackBerry, and that's sort of been a laggard. It hasn't been a great bet, but they have had other ones that have worked out extremely well. One of their largest current bets is in a company called Atlas, which is run by Dave Sokol, who used to be one of Buffett's top lieutenants at Berkshire. Atlas is a large container ship owner and operator. That's their larger segment is C-SPAN, and that's the container ship owner slash operator with around 186 vessels. Personally, I don't like commodity industries like container ships, but I view Dave Sokol as no dummy. Based on his experience working in the various different Berkshire subsidiaries, I thought he was an expert operator. And plus, he was one of the co-founders of the utility industries that Buffett has made a huge investment in. So I think he's a very shrewd operator, very shrewd capital allocator. And he, along with the rest of the management at Atlas, is guiding to around 600 to 700 million in adjusted profits in the years ahead versus their current market cap of around 3.5 billion. So it does strike me as like, oh, okay, Fairfax is making this bet, and I can understand. This is the traditional deep value investing that Prem Watsa, effectively the founder of Fairfax, is known for, making these sort of bets that aren't on most people's radar. This isn't Google trading at, let's say, 20 times earnings that strikes you as obvious. This is trying to find a cheap deep value play. Fairfax has also made a large bet on Eurobank, which at the time was a distressed bank. It's no longer. They've gotten rid of a significant amount of their non-performing loan portfolio. Now it's only like 10% of their portfolio or less. And, this bank is now profitable. It trades at 0.7 times price to book value and 7 times earnings per share. And just looking at using similar math to what you're looking at for Fairfax, if Eurobank continues to deliver and gets re-rated to, let's say, 1 times price to book, which it certainly can if they continue to execute, and they continue to grow at a good clip, you're looking at something with potentially hundreds of % upside as well. So these are asymmetrical bets, I would argue, and this is another very sizable bet for Fairfax. Management also has significant skin in the game with Fairfax. And just last year, Prem Watsa, the CEO, bought 150 million more in stock. That was around $309 per share. For these, I'm all using the US dollar prices. And since then, the stock's up about 32%. But look, he's a long-term holder. That's a big bet. He's saying, look, I have never seen Fairfax shares sell at a bigger discount to their intrinsic value than they have recently, was his comment with that. And so given all these factors that you consider, I think this is quite favorable. And I like the fact that they have such significant skin in the game. They also, in my opinion, very cleverly bought around $2 million worth of total return swaps at around $373 per share, which is around 7% of the company. To understand this a little greater detail, this is like a buyback, except they didn't have to put up all the money to do it. And so it's effectively a contract saying, hey, we'll get the price difference between X dollar price when they enter the swap and whatever price it is in the future. And they probably pay a couple of % per year to do that contract. And why this is compelling is this is, once again, putting their money where their mouth is, except in this way, as Fairfax stock goes higher, if it goes higher, they actually make even more money from the swap. So the swap becomes this contract, this derivative contract that they entered into becomes worth even more. So it almost becomes like self-fulfilling in a way. Is like the stock goes higher, Fairfax makes a ton of money potentially. So I've talked a lot about the ways this could work out. I think that one of the biggest ways that this could work out is with Digit potentially, growing to multiples of Fairfax in the future. So now I want to consider, well, what are the downside risks? And always, whenever you're looking at investing, I'd argue there are 3 core variables that drive the downside. There's debt, there's valuation, and there's an umbrella term, business risks. And on the first 2, when I look at debt and valuation, I'm pretty comfortable looking at it, particularly valuation. I'm very comfortable on the valuation side. On the business risk side, I think debt, they're conservatively financed. I don't view this as, like, oh, this is so levered, the next time there's a catastrophe, they're going to be in trouble. No, I don't view that as their business. The way I look at it is the core risks to focus on are around their business risks, in my opinion. And so let's talk about what I think are the top business risks. You can obviously go to their financials, their filings to go through all their stated risks. But here are the ones that are top of mind for me. So one is that Prem Watsa is old. He's around 70 years old, a little bit older now. This effectively, Fairfax is tied to the insurance industry. And the third, that value investing is dead. And we'll talk about all those right now. So the argument that Prem Watsa is old and that the returns, will suffer once he's gone, well, Look, he's building out a global investment team that is increasingly managing several billion of the Fairfax portfolio. I believe just two of his lieutenants are now managing about $3 billion in assets. And I think that's their stock portfolio. And keep in mind, their stock portfolio is only around $10 billion. So he's already outsourcing a significant amount of it to his investment team. And his investment team, has a geographic bent, as you can see here: Canada, Europe, Middle East, South Africa, Asia, India, South America. So they're looking around the world for opportunities. It's currently being vetted with Prem, and I think it does build a culture over time. So I'm not super worried that he's old. If anything, you could look at Warren Buffett and Charlie Munger and say, hey, he might have a few more decades in him because he's enjoying the game so much. So then the next component is tied to the insurance industry, and while there's always the risk of catastrophic insurance failure, the fact that they had a profitable underwriting in 2020 when many had significant COVID losses is a favorable data point. And the fact that the last 5 to 10 years has also been profitable is another favorable data point. And the fact that the insurance market is now in the hard cycle where prices start rising, and it's really whoever has the capital to do more business can do business, which is Fairfax, they're in a good position. So I'm looking at this and thinking, they're very excited about the insurance market where they are right now. They're seeing the cycle turn because insurance companies are sort of pulling back because of their COVID losses. And this is prime time for them to strike and grow their business. And then the third risk, in terms of talking about value investing being dead, I personally am skeptical of that view. I think a lot of people have seen the deep value-oriented buy stocks at low multiples approach really not work out for the last decade. On occasionally in spots it works, but broadly speaking, the cheap stocks approach has just been buying garbage. And the things that have worked have been buying, let's say, unprofitable companies that are just skyrocketing and growing significantly. And so, I think that won't always be the case, especially if you have an environment where interest rates rise. People will say, hey, I want a real yield. I really want to make sure that cash is coming in. It's not just future growth prospects. And so there's a possibility that that's always a benefit to them. It may not be. And the reality is, look at their bet on Digit. They effectively were the seed capital there, so that's not traditional value investing. And if anything, that's more of the latest and greatest in terms of saying, hey, let's use modern day technology to have an insurance tech business that can rapidly grow and take share. So you might actually have the best of both worlds looking at Fairfax. That's my personal take on Fairfax. If you have some thoughts, I'd love to hear it. Feel free to post some comments either below in the post here or in Discord. I prefer Discord where I can interact, and it's easier for me to interact on a daily basis. I also now have a dedicated Fairfax channel. So that way, if anyone has any particular questions in the stock channel, I can respond to it in the Fairfax channel so you can see that history there. If this video has been helpful for you, wait a second. This isn't the YouTube group. This is the Unrivaled Nation. You know what to do. Thanks so much for watching. And honestly, thank you so much for being part of this Unrivaled Nation. I'm grateful to be on this journey with you. Thanks.